Welcome, everyone. It's been a short time since our last market update, but a lot has changed. I'm Valerie Leonard, CEO and founder of EverThrive Financial, and I'm here to break it all down for you. Here's what you need to know this month to help protect your money as an investor. So let's start by addressing the elephant in the room. And of course, that is conflicts in the Middle East, particularly in Iran. They've definitely escalated. So what does this world event mean to you and your money from a day-to-day standpoint? Well, I want to start by talking about what it doesn't mean. It doesn't mean that you should rush out and pull all your money out of the stock market. This chart goes all the way back to 1896 and shows market performance after every major conflict all the way through 2025. So you're going to see here world wars, the Depression, the tech bubble, 9/11, the COVID pandemic, the Russia and Ukraine conflict, and lots more. And conflicts historically mean that we're going to see short-term volatility, but not necessarily a long-term bear market. And so to drill down even further, when you look at the massive events that are listed on this chart, it's important to note that total sell-offs in the market, as we're measuring here, which we're looking at the S&P 500, typically, of course, are going to be pretty sharp initially when the headline comes out. So as you can see here, the total drawdown after the attack on Pearl Harbor was just shy of 20%. A 20% loss definitely feels very real, right? After Iraq invaded Kuwait back in 1990, the market sold off almost 17%. And you can pause the video here to drill down on this chart further. But this chart also shows you the number of days that it took the market to bottom after each event. So 143 days in the case of the Pearl Harbor attack versus only 8 days during the Cuban Missile Crisis. And then, of course, the last row here also shows you the number of days that it took for the market to recover those losses, such as 31 days after events at 9/11 or only 1 day after the Kennedy assassination. And other geopolitical events are listed here, most notably the recent war between Russia and Ukraine and the North Korean missile crisis back in 2017. And the point is that the total average sell-off in the S&P 500 was 4.4%. That's pretty mild, while it took the market roughly 18 days on average to fully bottom when you're looking at all of these events together. And it took 39 days for the market on average to recover those losses. So what's the moral of the story? Sell-offs can be sharp, they can be scary, but time to recovery in the market historically has been relatively short in the grand scheme of things. So how did the stock market perform after these events listed on previous slides? It really depends on one key factor, and that was the economy already in or near a recession when the event occurred? So here you can see the average returns for the S&P 500 1 month, 3 months, 6 months, and 12 months after the events that were listed on the previous two slides. You're also going to find on row 2 the average performance for these time periods if no recession was on the horizon for each respective event. And row 3 shows the average if a recession occurred in conjunction with the event. So the bottom line here is that these types of events do increase volatility in the markets, but they generally will not derail a fundamentally sound economy. Our economy has been pretty strong lately, and while past performance, of course, is no guarantee of future results, it does help us educate ourselves when we look back at historical reference points. Related to this, we also understand the instinct to move your investments to cash right now. We are very emotional human beings. That's in our nature. And we often feel the need to take action or to fix something that feels broken. A lot of times we run away from pain a lot faster than we run towards pleasure. And that can be true when investing as well. So it may seem counterintuitive, but a smart way to help protect your investments is to position in a way that you can participate in potential future opportunities. If you sell and go to cash today, you don't get that opportunity. This chart's really important. JP Morgan did a study and found that missing just the 10 best days in the market over a 20-year period can diminish your total returns by roughly 50%. that is a substantial loss and definitely a missed opportunity cost. So if you have a diversified portfolio and you're investing within your risk tolerance and your time horizon, then you can help protect your money by thinking more for the long term and doing your best to set your emotions on the shelf. And no one can predict when the best days will happen in the market. So we encourage you to stay invested because that's what gives you the potential opportunity to benefit from market upsides when they happen. There's always exceptions to that rule, but in general, if you're a longer term investor, try to keep that long-term focus. Okay, so let's talk about what's happening in the market today. We are seeing an interesting rotation happen with a really big divergence across sectors. So what you'll notice here is back in 2025, communication services and technology were the best performing sectors last year. Communication services were up over 33%, technology up over 24%. And then you can see how each sector performed. And on the far right-hand side of the page, you'll notice that the S&P 500 was up 17.3% last year. That's that bottom row. Now, if you fast forward and look at the year-to-date column, what you'll notice is communication services and technology are nowhere near the top when it comes to performance. So we're definitely seeing that rotation. And it's incredible to see some of these sectors and how they've performed so far since January 1st of this year. Energy, of course, being the big headline that we're going to talk more about here in a minute, up 29.5% as of yesterday's close of business. I'm recording this on March 17th, 2026, by the way. And then you'll see other sectors like consumer staples up 9.4%, utilities up 10.78%, materials up almost 9%, real estate up 5.5%, and so forth. So obviously there's certain things that are performing, and then there's other things that are not performing. The market is down by about 2% as of close of business yesterday, so definitely very flat for the year, but still holding up quite nicely given all the conflicts that we're seeing in the Middle East and the spike in oil prices. So when sectors rotate, people often ask us, how does this impact me at a household level? And folks are especially asking this question about gasoline prices given tensions in the Middle East right now. We've seen oil and gas prices spike, with gallons of gas up by 74 cents just since the conflict in Iran began. And of course, nobody likes higher prices at the pump, but do keep in mind that this too shall pass. And recent price spikes don't necessarily indicate permanent price hikes, although we are watching conflicts closely and we are definitely concerned because Iran is, very important when it comes to oil production. 20% of the world's oil comes from that region. And this chart shows the energy sector over the past 20 years. You can see very clearly the spike on the far right-hand side of the screen. If you go back and look at oil prices, historically, they're very, very high at the moment, going back 20 years. Now let's move on to one of our most favorite seasons, and that is tax season. Since you're probably in the process of preparing your 2025 tax return, understanding President Trump's One Big Beautiful Bill Act is going to be very important. And this bill was signed into law on July 4th of last year. It included some key changes that will affect your taxes for the 2025 tax year and going forward. So I'm just going to hit some of the highlights. First of all, know that we saw an increase in the standard deduction. So the Tax Cut Act back in 2017 increased the standard deduction, and the One Big Beautiful Bill Act made this permanent and adjusted it to inflation. So the standard deduction is adjusted in 2025 to $15,750 for single taxpayers and $31,500 for married taxpayers that are filing jointly. Also, we saw an increase in the state and local tax deduction. We call this the SALT deduction. So the cap of state and local tax that a taxpayer can claim as a deduction has been increased to $40,000, and it's adjusted to inflation, but it will revert back to $10,000 in 2030. 30. The deduction is reduced by 30% if your modified adjusted gross income is over $500,000, and that's for both single and married taxpayers. But the deduction cannot be less than $10,000. Also, let's talk about the senior exemption. This is a temporary $6,000, what we call between the lines deduction. And this applies to taxpayers who are age 65 and older, and they can claim this tax deduction through the calendar year 2028. The deduction amount is phased out for single taxpayers who have modified adjusted gross income over $75,000 and married taxpayers who are filing jointly with modified adjusted gross income over $150,000. This deduction is fully eliminated if modified adjusted gross income is over $175,000 for single taxpayers and over $250,000 for married taxpayers. And so while this has been portrayed as eliminating taxes on Social Security benefits, it will have a minimal impact for middle and high income claimants. Now, we've heard the media talk a lot about the deduction for tips and overtime pay. So temporary above the line deductions are introduced for tips, $25,000 for qualified tips that are received by an individual who works in an occupation that customarily and regularly receives tips. And then also this applies to overtime pay up to $12,500 for a single individual and $25,000 for a married couple. Now, both of these deductions do phase out for single taxpayers with modified adjusted gross income over $150,000 and married couples filing jointly with modified adjusted gross income over $300,000. And these deductions will be fully eliminated in 2029. Let's talk about the child tax credit. The partially non-refundable tax credit is increased to $2,200 per child. It is going to be adjusted for inflation for later years. The $1,400 refundable part of the credit has been made permanent, and that will be adjusted upward for inflation in future years. And then the $500 non-refundable credit for dependents other than qualifying children is also made permanent. Let's talk about 529 plans. This is a big one. If you have a college fund for your kids or you're thinking about starting one, 529 plans can possibly be a great way to do that. So qualified expenses now include post-secondary credentialing expenses. There are more expenses that are added to the list where you can use 529 funds, and that includes elementary and secondary school qualified expenses in 2026, such as materials and books, as well as tuition for tutoring and educational classes outside of the home. Next, let's talk about a new one. This is the new car loan interest deduction. So in this case, interest paid on a qualified passenger vehicle new loan will be deductible temporarily until 2028. The deduction is limited to $10,000 a year, so you'd have to have a pretty big loan in order to tap out that limit. And it only applies to personal vehicles that had their final assembly in the United States. Tax rates in general that were introduced by the tax legislation back in 2017 were made permanent, and we saw some slight upward adjustments to the top of the 10% and 12% tax brackets. And then home mortgage interest deduction. So the One Big Beautiful Bill Act permanently extended the limitation on deducting qualified residence interest to the first $750,000 in home mortgage acquisition debt. That was previously $1 million, just to kind of give you a point of reference there. Now it's $750,000, and it treats certain mortgage insurance premiums on acquisition debt as a qualified resident interest. It also confirms the inability to deduct interest on home equity loans, which has been the rule for quite some time now. Now, here is a big one. If you've tuned out, if I put you to sleep, pay attention to this one. If you are a tax filer who claims the standard deduction, you now can get a new above the line deduction for taxpayers who use that standard deduction. You can deduct charitable contributions to a qualified 501c3 up to $1,000 if you're a single taxpayer and up to $2,000 for a married couple filing jointly. If you itemize, on the other hand, you will face a new limit to what you can deduct from a charitable contribution standpoint. Those charitable contributions will need to exceed 0.5% of the taxpayer's contribution base in order to be deductible. So the contribution base is defined by the Act as adjusted gross income without any net operating loss carrybacks. Finally, let's talk about Trump accounts. The One Big Beautiful Bill Act creates special IRAs for children under age 18. Contributions can only be made in calendar years before the beneficiary reaches age 18, and they're limited to $5,000 a year. That will be adjusted for inflation after 2027. But distributions of the funds from these Trump accounts can begin in the calendar year the beneficiary reaches age 18. Distributions are going to be tax-free on the amount that you contributed. We call that the basis, while distributions of any income earned on those accounts will be treated as IRA distributions and subject to ordinary income tax and the 10% early withdrawal penalty if you take money out prior to age 59 and a half. There are some exceptions to that. So a $1,000 tax credit is being offered for opening a Trump account for a child born between the years 2025 and 2028. And the bill also allows for employer contributions to Trump accounts. That's a new one. And these contributions will not be included in the employee's income if employers choose to make that benefit available. So investment options for the account appear to be limited to mutual funds and exchange-traded funds that track the S&P 500 or another qualified index. So definitely have a few options there. So thank you so much for joining me today. Here's one final thought before you go. We put these videos out each month to help you make smart and confident decisions. So please go ahead and hit subscribe to our YouTube channel if you haven't already. If you want to explore your investments on a deeper level, or if you're losing sleep at night worrying about your portfolio, know that we are here for you. If you're not yet one of our clients and you want EverThrive to work for you, please feel free to scan this QR code or schedule an introductory call with us via phone. We certainly will be happy to help. There are lots of ways we can help you, whether it's through investment management or comprehensive financial planning. We certainly are here to be a resource to you. So we thank you so much for joining us, and we look forward to seeing you again next month.